Felix here. The Fed has just caved in, possibly to market pressure. What does it all mean? Let me break it down for you in the next couple of minutes. Winston's lying on the floor down there, looking very excited about the prospect of going out after this video. Of course, none of the following is financial advice. I know that's what you're really here for. And let me show you my screen. Whoops, it's the wrong screen. All right, let's fix that. Here is the excitement. Here it is. So this chap, James Bullard, why does he matter? He's a Fed president. He's the most hawkish of the hawks. He's basically the guy who was saying all of 22, let's get rates up to, whatever it takes, just break the spine in 6 places of the average American employee. And that's how we get inflation down. And let me show you that that's true. This is from Reuters. Right, so this is a list that's lengthy of all the Fed presidents, and it tells you at the top whether they're dovish, what is the word? I never know. Some sort of bird or a hawk. And people like Brainard are, very much on the softy side. And then there are 2 people down here who are the hardcore. And Bullard is the one we hear from every single day, basically. He was talking endlessly in 2022. So the hawk has come out, and the hawk has become soft and fluffy and says, tickle my little belly. So what's he said? He said there are optimistic signs, and it gets better than this phrase sentence, don't worry. Optimistic signs that price gains could slow further this year and that the central bank may succeed in taming the strongest inflation in a generation, essentially saying, they're heroes, right? They should get the Congressional Medal of something or other. He stopped short of hammering home the hawkish tone he delivered throughout much of last year. This is Bloomberg. We're not exactly, Doomberg, we call it. The policy rate is not yet in a zone that may be considered sufficiently restrictive, but it's getting close, he says. Well, how close? How close? So you can see it here. 5.1% is where he thinks we're going to be. Why? Because we've got his full presentation. I'll put the link down below for you guys if you want to read the original materials. Here it is. This is his presentation, James Bullard. And you can see from that, there's this chart in it. And essentially, it says in one little red star, the projection is here slightly, ever so slightly, above 5%. So let's call it 5.1 or 5%. And that is better than we had previously expected. Why is that? Well, let me jump past that. There is something called the Fed Watch tool, great website, highly recommend it if you're a data geek like me. And there are instruments that we trade that predict where the Fed rate's going to end up. So it's not some sort of poll of 12 people somewhere in Minneapolis. These are actually traded instruments. And they are basically saying that in May this year, interest rates are going to peak at about 5 to 5.25%. So him saying it's going to be 5.1, it means it's priced in. There is no further nasty upside to interest rates. And remember, 1% higher interest rate gives you about minus 9% on a growth stock, right? So that's why this stuff really, really matters. And we've previously been thinking that the market is underestimating how far the Fed will go. That was always the implication from what the Fed was telling us in their minutes. And here, the most hawkish of the hawks at the Fed's table comes out and goes, we're almost there, guys. So what does it mean? Well, it means we're going to get 3 times more, 0.25%, or we might get 1/2 point in Feb if inflation comes a little higher than expected, and then another quarter, and then we're basically done. So it means we're almost there. It's priced in. It's brilliant, isn't it? Does that mean the stock market's going to completely fly off the handle and we'll be celebrating with lots of champagne with the Fed, who are probably celebrating their little achievements, making more people unemployed, although that doesn't seem to be so easy for them, it seems. Not really. These are the predictions from all the major investment banks. So JP Morgan says by the end of the year, we'll be at 4,200 with the S&P, Credit Suisse 4,050, Goldman's 4,000, Bank of America 4,000, Morgan Stanley 3,900, and the English lot at Barclays are really miserable. It's probably raining in London, so they say 3,725. So what does that mean? Well, it means this is priced in, right? This data came out a couple of days ago when the market was already expecting this. But now that it's confirmed, doesn't necessarily really change our year-end target because we still have these rates for long periods of time, probably for all of 2023, if you believe the Fed. So what does it therefore mean? The year is probably still going to be somewhat disappointing. It's still going to be somewhat flat, and we're not going to get quite the 10, 12, 14% returns that we are used to on our stock portfolios in the last 20 years or so. Why is that? Because they're still shredding money. So even if the interest rates only go to 5.1%, they're still shredding money, and money shredding is the equivalent of rate hikes. It removes liquidity from assets. It means there's less money gushing about seeking returns and therefore driving asset prices up. So it's still not going to be, the bull year. I'm still bearishly optimistic, if that's a phrase. So I don't expect real fireworks here. And therefore, I'll continue to trade. That's what I continue to focus on if you want to see how we've been doing. Last year, we did 126% return on capitals. We made, on this is a small portfolio, run completely live for the community to encourage sensible, responsible trading. And we made a $16,000 profit on $13,000 capital used. So 16,000 on top of the 13, right? Which is a pretty decent return. So if you want to see how we do that, and without me promising you exactly those returns, because I don't think that would be honest. I'm not a fan of that sort of thing. But I can promise you that I'll share with you every single trade. I can promise you that I'll share you exactly my strategy, my thoughts, my insights, how it really works. You have access to me and my coaching team of investment bankers. Then provided you have a 5-figure portfolio, come and check it out at felixfriends.org/coaching. Just book a call with us. We are friendly, nice people. Just have a chat, see if it's a right fit for you and for us, and we'll be very honest with you on that as well. If you're just getting cracking, if you're just starting out, your portfolio isn't quite at the 5-figure level yet, well, let's, again, help to build that passive income stream and take matters into our own hands. That's always why I say, like, the market's flat, the market's even down. I enjoy it because I make income. It means I can buy the great companies that I like to buy every week at lower prices, right? So it kind of makes sense. So for the course, go to felixfriends.org/options. That's 100 lessons pre-recorded. You get to watch me trade live every week, and there's unlimited chat support and so on. It's a fantastic community as well. So check that out. So positive, yes, not life-changing yet. Life-changing will be when they basically say rates are where they need to be, and we're not going to raise them anymore. But we've now kind of taken the elephant out of the china shop, which was, well, are they going to go to 5.5? Are they going to go to 6%? And basically the most hawkish guy on the planet saying, no, we won't. We're almost there. 5.1% is where we need to get to. So we're very, very close. It's good news. Very, very good news, I think. So I wanted to share that with you. If you enjoyed this kind of content, guys, smash the like and subscribe button. I truly appreciate that. And give us a call and see if we can make your 2023 a better year, and you can really start to understand financial markets and have fun in a lull market. And that's what we do. So thanks for watching. Appreciate you tuning in.